$38 trillion, that is the number sitting on the books right now, document. The official U.S. national debt as of this recording, $38,400 billion and change. And I need you to understand something before we go any further. That number is not going to be paid back, not in the way you think, not with tax revenue, not with spending cuts, not with any policy debate you have ever watched on cable news. It is going to be erased, quietly, slowly, in a way that will drain your savings, crush your purchasing power, and reward everyone who understood what was happening before it was obvious. And right now, the playbook is already in motion. The data is already there. The numbers already don't add up a euro unless you understand what they're actually doing. Stay with me, because by the end of this video, the last 12 months of financial news will suddenly make complete sense. You're watching this because the mainstream won't show you what $38 trillion in debt actually means for the dollar in your wallet. They'll debate the debt ceiling, they'll argue about interest payments, they'll talk about it in abstract political terms designed to make your eyes glaze over. But here's the thing they are not telling you. The United States has wiped out massive debt loads before, not by paying them off, by inflating them away. And right now, every single policy signal, Arobro, from the Federal Reserve, from the Treasury, from the currency markets, from the gold vaults, Arobro, is pointing to the same playbook being executed again, right now, in real time. Let me give you the first number that should stop you cold. The U.S. debt to GDP ratio currently sits at approximately 124%. That means for every dollar of economic output this country produces in a year, it owes $1.24. That is not a manageable number. That is not a number you grow your way out of through productivity gains. Historically, when a sovereign nation hits a debt to GDP ratio above 90%, the traditional tools, austerity, growth, tax increases, stop working. The math doesn't close. And the countries that have been here before have used exactly one reliable escape mechanism. They inflate the debt away. Here's how it works in plain language. If you owe $38 trillion in fixed dollar terms and you engineer inflation at 6%, 7%, 8% per year, you are effectively shrinking the real value of that debt by that percentage every single year. The nominal number stays the same. The debt clock keeps ticking, but the purchasing power behind every dollar of that debt gets quietly, systematically destroyed. After 10 years of 7% inflation, the real value of $38 trillion in today's money falls to roughly $19 trillion. You didn't pay it back. You didn't default. You just made the money. It's denominated and worth half as much. And here's the part that should concern you personally. You pay for it, not through taxes, through your savings account earning 0, 4% while real inflation runs at 6, through your bond portfolio losing value in real terms, through the price of everything you buy going up while your wages chase it oro, but never quite catch it. That is the mechanism. And right now the data is screaming that this mechanism is being activated. But that's not the part that should concern you most, because the inflation is not the only tool. There are 3 tools in this playbook, and all 3 are being deployed simultaneously right now in 2026 in a way that hasn't happened since the late 1970s. Tool 1, financial repression. This is the technical term for keeping interest rates artificially below the inflation rate, when the Fed holds rates at, say, 5%, while real inflation is running at 6 or 7%. Every holder of U.S. Treasuries is losing real purchasing power every single year. They're just not told to call it a loss. The Congressional Budget Office right now projects that net interest payments on U.S. debt will exceed $1. $6 trillion by 2027. That number is not sustainable at market rate interest, so the rates cannot be allowed to go truly market rate. They will be held down. And the gap between the rate you earn and the rate of real inflation is the silent tax being levied on every saver in America. Tool 2, dollar devaluation. The US dollar index, EURIBOR, the DXY, which measures the dollar against a basket of major currencies, EURIBOR, has been trending down. As of this recording, it has lost significant ground since its peak above 114 in 2022. A weaker dollar makes US exports more competitive. It also makes the real cost of servicing foreign-held debt smaller in purchasing power terms. And it funnels capital away from dollar-denominated savings toward hard assets, real estate, commodities, and most importantly for this conversation, gold. Tool 3. And this is the one Wall Street is not confused about. They know exactly what this means. Gold repricing. In every historical cycle where a reserve currency nation has used inflation to erode a debt load, gold has repriced upward euros, not as a speculative bubble, but as a mathematical recalibration. The price of gold is, at its core, the inverse of confidence in the currency it's priced in. When the dollar's purchasing power falls, gold's dollar price rises. Not because gold changed, because the measuring stick changed. And right now, paper says gold is trading around $3,100 an ounce. But the vault says something different, because the pace of physical gold accumulation by central banks, by sovereign wealth funds, by the Shanghai Gold Exchange, is running at levels not seen since Bretton Woods was being dismantled in the early 1970s. That is not a coincidence. That is preparation. Subscribe right now to The Hidden Economy or Irudao, because what I'm going to show you in the next 12 minutes is the specific data trail that connects U.S. debt policy to gold market structure in a way that will completely change how you read the financial headlines. Hit subscribe, hit the notification bell, and let me show you the pattern. Let's build the evidence stack, piece by piece, because each one of these data points on its own has an innocent explanation. But when you line them up, for all 5 of them are a row, the innocent explanation stops being mathematically possible. Piece 1, U.S. Treasury issuance structure. In the last 18 months, the Treasury has been deliberately skewing its new debt issuance towards short-duration T-bills, 90-day 6-month maturities, rather than locking in long-term debt at current rates. As of early 2026, roughly 31% of the entire U.S. debt load is in short-term bills that need to be rolled over within the next 12 months. That's approximately $11, $8 trillion coming due for refinancing in less than a year. Now, why would the Treasury do this? The mainstream explanation is that it's a tactical move to maintain flexibility. And that's partially true. But there is another explanation. If you believe rates are coming down significantly, because you're going to engineer them down, then locking short is exactly what you do. You roll the debt repeatedly at lower and lower rates as financial repression takes hold. You avoid locking in today's 5% for 30 years. You plan to refinance at 2%, 3% but only after inflation has already quietly done its work. Paper says this is just prudent debt management. The vault says something different, because the entities buying those short-term bills at rates below real inflation are accepting guaranteed real losses. And the only entities who absorb guaranteed real losses on U.S. Treasuries are those who have no choice. Money market funds, commercial banks with regulatory requirements, and foreign central banks managing currency pegs. They are the captive buyers, and they are being systematically harvested. And it gets worse. Piece 2. The Federal Reserve's balance sheet and its relationship to gold. Here's a number that almost nobody in mainstream financial media discusses. The Federal Reserve currently holds approximately 8,133 metric tons of gold, or claims to. That gold is the bedrock collateral underlying the dollar's residual credibility as a reserve currency. But here's what's happening in the broader central bank world simultaneously. Global central banks purchased over 1,000 metric tons of gold in both 2022 and 2023 overs. That's 2 consecutive years above the 1,000-ton threshold. The World Gold Council data shows this is the highest sustained central bank buying pace since the end of the Bretton Woods gold standard in 1971. Why does that matter? Because central banks buy gold when they are hedging against their own currency. And the specific banks doing the buying are not random. China's People's Bank of China has been officially reporting gold reserve increases for more than 18 consecutive months. Russia has rebuilt its gold reserves to over 2,300 tons, more than Germany. India added 72 tons in a single 12-month period. Poland, Hungary, Singapore, not traditionally gold-heavy nations, all added significant physical tons. Once you understand the ratio between paper-priced gold and the physical accumulation happening at the sovereign level, the price action makes complete sense. The paper market is priced for a world where the dollar remains the dominant global reserve. The physical market is being structured for a world where it isn't. Those 2 markets are pricing 2 different futures simultaneously. And that gap, right now, is the opportunity and the warning sign in the same breath. But here's what they filed at 3 a.m. that nobody is talking about. In January 2026, the U.S. Treasury Borrowing Advisory Committee, the TBAC, which is essentially the inner council of primary dealers who advise the Treasury on debt management, flagged in its quarterly report that the sustainable debt level relative to GDP requires nominal GDP growth of at least 2% annually to prevent debt to GDP from accelerating. Current real GDP growth projections are running at 1, 8% to 2%. To get nominal GDP growth of 2% with only 2% real growth, you need 3. 2% of inflation built structurally into the system, not as a crisis, as a feature. 3.2% inflation, running structurally and permanently, is the minimum requirement to keep the debt to GDP ratio stable at current levels. But here's the problem. 2% is the floor, not the target, because the debt is still growing. The deficit is still running at $1, 8 trillion annually. So the inflation rate required to actually shrink the real debt load, not just stabilize it, has to run higher than 2% consistently. Wall Street is not confused about this. They know exactly what this means. The question is whether you do. And this brings us to the historical pattern, because this playbook has been run before, twice in living memory, and both times it ended the same way. Same playbook, different decade. After World War II, the United States carried a debt-to-GDP ratio of approximately 119% reserve, almost exactly where we are now. The country did not pay it off. Between 1946 and 1980, the U.S. used a combination of financial repression, mild but persistent inflation, and strong nominal GDP growth to reduce that ratio from 119% to under 30%. The real value of the war debt was inflated away over 35 years. The bondholders who held fixed-rate government paper during that era lost enormous purchasing power in real terms. The people who held hard assets, farmland, real estate, gold, when it was finally allowed in 1975, Arwaro preserved and built wealth, and then it happened again. In the late 1970s, when inflation became too visible to ignore, the Fed under Paul Volcker made a dramatic public show of breaking inflation by hiking rates to 20%. But here's what that era actually produced. Gold went from $35 an ounce in 1971 sotaferro, when Nixon closed the gold window, which was itself an act of debt erasure, to $850 an ounce by January 1980. That is a 2,300% repricing in 9 years. Not because gold changed, because the dollar, burdened by 2 decades of financial repression, finally showed its debasement in the price. Once his accident, twice his coincidence, 3 times his policy. We are now at the beginning of the third cycle, and this time the debt is larger relative to GDP than it was entering either of the previous 2 episodes. The dollar's reserve currency status provides a temporary buffer, aja. Foreigners are still required to hold dollars for trade, wout. But that buffer is eroding. The BRICS nations' stated goal of reducing dollar dependency in bilateral trade has moved from rhetoric to reality. Russia and China now conduct the majority of their bilateral trade in local currencies. The petrodollar AWO. The arrangement by which oil is priced globally in US dollars, AERO, is under open challenge from Saudi Arabia's discussions with China about yuan-priced oil sales. The premium for holding dollars is fading, and when it fades, the inflation required to service the debt will not stay quietly at 2%. It will escalate. And that is the specific moment the gold market is pricing for, right now. 6 months, 12 months, 18 months ahead of when most retail investors will understand what happened. The gap didn't close, it widened. The spread between where gold should be priced based on US M2 money supply growth since 2000 and where it is currently priced in paper markets has been closing dramatically. In 2020, gold at $1,900 was still below its fair value by the M2 measure. At $3,100, it is closer oburu. But if M2 has grown by approximately 190% since 2000, and gold is the monetary asset denominated in dollars, the implied fair value based purely on money supply is north of $4,500 per ounce. The paper market is still pricing this like 2019. The physical market, the central bank accumulation data, the sovereign vault movements, Arwao, they are pricing something else entirely. Subscribe to the hidden economy right now. I'm going to keep breaking down what the big players are doing so you are never caught off guard. Hit the bell, because what I'm about to show you in Act 3 is the specific implication for your portfolio Esterao, and who gets hurt when this repricing accelerates. Let me tell you who gets hurt, not in vague terms, specifically. The first category of people who get hurt are those sitting in cash, in savings accounts, money market funds, CDs, believing they are being safe and patient. If structural inflation runs at 4% to 6% for the next decade, and your savings account earns 2% ARO, you are losing 2% to 4% of real purchasing power every single year. On $100,000 in savings, that's $2,000 to $4,000 of real wealth destroyed annually, silently, without a single market crash, without any headline screaming at you, just steady, invisible erosion. The second category, bondholders. If you are holding long-duration U.S. Treasuries or 10-year, 20-year, 30-year bonds, and inflation runs above the yield for a sustained period, you are in the worst possible position. You locked in a fixed return below inflation for decades. The bond price falls as rates rise, and the real purchasing power of your principal falls as inflation rises. You lose on both ends simultaneously. This is called the inflation tax on fixed income, and it is the specific mechanism through which financial repression transfers wealth from savers to debtors. The largest debtor in the world right now is the U.S. government. The third category, Awiro, and this is the one that most viewers watching this right now fall into Awiro, are people who understand what's happening but have not yet acted. Not because they're stupid, because they're waiting for certainty, waiting for the mainstream to confirm it, waiting for the Fed to admit it, waiting for a headline. That headline will not come. This is not financial advice. Your money, your decisions. But I will tell you what the data is saying. By the time this is front page news, by the time CNBC is running segments about the dollar's structural decline, the repricing will already have happened. The gold will already have moved. The silver will already have moved. The inflation-resistant assets will already be priced at levels that make the entry point painful. This number doesn't exist in a fair market. 356 paper claims for every 1 physical ounce of deliverable gold on the COMEX. That is the registered to open interest ratio that has been documented in CME delivery reports. 356. In a genuinely transparent, physically backed market, that ratio could not persist. It exists only because the vast majority of paper contract holders never intend to take delivery. They are speculating on the price, and as long as that's true, the paper price can be managed pushed down during key periods, dampened at critical technical levels, kept below the price that physical demand in Shanghai or Mumbai or Istanbul would otherwise set. But here's what they're not telling you about the COMEX ratio. It's been compressing. 18 months ago, the ratio was above 400. Today, it's closer to 356. And if you track the historical pattern, every time this ratio has compressed significantly every time more paper claims have been either settled or abandoned it has preceded a violent repricing in the physical market. Not because the manipulation ended, because the physical shortage became impossible to obscure. The premium held through the entire dump. In every recent paper price pullback, every coordinated margin hike, every technical breakdown, the physical premium over spot held firm or widened. You can go on any major dealer website right now and check. The spread between the paper market spot price and the actual price you pay for a 1-ounce gold coin or a 100-ounce silver bar, that spread is not shrinking. In some categories, it is at multi-year highs. Paper says one thing. The real market, the market where physical metal changes hands, says something different. And then something strange happened to the vault numbers. In the fourth quarter of 2025, the Swiss National Bank's gold storage statistics, Switzerland being the world's largest gold refining hub, processing roughly 70% of global gold flows, showed an anomaly. The volume of gold being refined and shipped eastward, to China, India, UAE, accelerated sharply, while the volume being retained in Western vaults declined. This is not unusual in isolation. But when you overlay it with the Bank of England's gold lending data, which shows outstanding gold loans at their lowest level in over a decade, you get a picture of Western central bank gold flowing steadily, quietly, 1 ton at a time, toward Eastern vaults. Western central banks are not accumulating. They are maintaining, or in some cases are, quietly, off-balance sheet, they are lending. Eastern central banks are accumulating aggressively. This is a directional flow of the world's monetary bedrock, and it is accelerating. Now let me give you the 3 types of people watching this video, because I've watched this channel long enough to know exactly who is here. Type 1 is scared right now. They're watching their dollar-denominated savings and feeling a vague, unsettling anxiety they can't quite articulate. They're reading headlines about debt and deficits and feeling paralyzed. They're going to do nothing. And that decision, the decision to do nothing, is itself a decision. It is a vote of confidence in the very system being described in this video. If you're type 1, I need you to stay until the end, because the data does not require panic. It requires clarity. Type 2 is intellectually curious, but skeptical. They think this sounds compelling, but also sounds like every doom prediction they've heard for 15 years that never fully materialized. And they have a point. The dollar has been dying for a long time. Gold was supposed to be at $10,000 by 2015, according to some predictions. The system has been more resilient than expected. If you're type 2, I respect the skepticism. But I want you to notice something. The question is not whether the dollar collapses tomorrow. The question is whether holding 100% of your wealth in assets denominated in a currency that its own government is deliberately debasing is the optimal portfolio construction. You don't have to believe in catastrophe to believe in diversification. Type 3 already owns physical metal. They've been stacking. They're watching this to confirm what they already sense that the thesis is intact, that the timeline is compressing, and that the noise designed to shake them out is exactly that. Noise. If you're type 3, you're right to be patient. The premium holding through every paper dump is the confirmation signal. The physical market is telling you the truth that the paper market is trying to obscure. Here's what the practical picture looks like. For physical holders, your job right now is to not be shaken out. The paper price will be volatile. That is not an accident. Volatility is the mechanism through which weak hands are separated from strong ones. The COMEX paper market has the tools to push the spot price down in the short term. They can hike margins, they can flood the tape with synthetic supply. What they cannot do, AWO, and this is the critical point, AWO, is create physical metal. They cannot mint new ounces. They cannot conjure deliverable gold from thin air. And when the paper price diverges far enough from the physical replacement cost, the arbitrage collapses and the price rips. For people sitting on the sidelines, the question you need to ask is not, is now the perfect moment? The question is, am I comfortable holding zero inflation-resistant assets while my government openly discusses needing 5% plus nominal GDP growth to stabilize a $38 trillion debt load? Because that 5% nominal GDP growth is not coming from productivity, it's coming from prices. For those still heavily in long-duration bonds, the math is brutal and it doesn't require catastrophe. A sustained inflation rate of 5% with a 4. 5% treasury yield means you are losing 0. 5% of real purchasing power annually on the principal AWO, while also watching the market value of your bonds fall as rates potentially move higher. This is not a crisis scenario, this is the base case. This is the mild version of financial repression working exactly as designed. Wall Street is not confused about this. They know exactly what this means. The largest financial institutions in the world are not sitting in 30-year treasuries with their own proprietary capital. They are in real assets, commodities, inflation-linked securities, and alternative stores of value. The product they sell to retail either the 60-40 portfolio, the bond allocation, the safe haven, fixed income narrative, or is not what they hold for themselves. The asymmetry of information is not subtle, it is structural. And here's where the controlled outrage is warranted, because this is not new. This is not a secret discovered by fringe analysts in dark corners of the internet. The academic literature on financial repression, the Carmen Reinhart papers, the work of the Bank for International Settlements, the IMF's own working papers on debt reduction strategies, ABAO. All of it is publicly available. The playbook is documented. The historical precedents are undeniable. The data showing it being activated right now, Bureau, the short-duration debt issuance, the below-inflation rate environment, the central bank gold accumulation, the dollar index trend, the M2 expansion, all of it is in public filings and public data sets. The information is available. The analysis connecting it into a coherent picture is what the mainstream will not give you. And the reason the mainstream will not give you that analysis is not a grand, coordinated conspiracy. It's simpler than that. Financial media is funded by financial institutions, the same institutions that manage your 401k, sell you bond funds, run your money market accounts, and charge management fees on the very instruments that perform worst in a financial repression environment. The incentive is not to hide the truth. The incentive is to not say the thing that causes you to move your money somewhere they can't charge a fee on it. Paper says X. The vault says something different. The vault has been saying something different for 18 consecutive months of above 1,000-ton central bank gold buying. The vault has been saying something different through every paper price dump where the physical premium held. The vault is saying something different right now, today, as the COMEX ratio compresses and the Swiss refiners ship metal east faster than the Western paper market can pretend it isn't happening. The West is still pricing this like 2019. The East is pricing something else entirely. And history tells us that eventually those two prices converge, not at the Western paper price, not at some comfortable middle ground. They converge at the price that reflects the actual scarcity of the physical metal, eau de brosseur, and the actual debasement of the currency it's priced in. So let me close with this. The question I get most often is, how long does this take? And the honest answer is, longer than you think, and then all at once. Currency debasement cycles are slow. They are designed to be slow. The boiling frog metaphor exists precisely because this is how it works. Not a dramatic crash, not a single crisis moment, but a gradual, barely perceptible erosion that is invisible in any given week and devastating over any given decade. The people who protected their wealth in the 1970s, the inflation decade, the financial repression decade, were not the ones who timed the market perfectly. They were the ones who understood the structural direction and ZS, every gold is dead narrative. $38 trillion does not get paid back. Not in the way you think. It gets erased, quietly, methodically, using tools that have been deployed before, documented in academic literature, and are right now visible in the data AZAO if you know where to look. You now know where to look. Here's what I need you to do right now. Drop a comment below. What percentage of your net worth is in physical hard assets, gold, silver, or otherwise, azuriro, versus dollar-denominated paper? I read every single comment, and I want to see where this audience actually stands, not where you think you should be, where you actually are. Be honest. Send this video to one person in your life who is sitting in cash or bonds and wondering why their purchasing power feels like it's eroding, even though nothing bad has officially happened yet. Most people will never see this kind of analysis. The mainstream will not cover it, but you saw it, help someone else see it. If you are not subscribed yet, fix that right now. Subscribe to The Hidden Economy. This is the kind of analysis you will not find anywhere else. Whoa, Rouse. Not because it's radical, but because it's inconvenient for the people who profit from your confusion. And finally, save this video, screenshot this, hold me accountable. Come back in 12 months and tell me if the structural inflation is still running above Treasury yields. Come back and tell me if central bank gold buying is still above 1,000 tons annually. Come back and tell me if the COMEX registered to open interest ratio has kept compressing. I will make the follow-up video, and we will look at these numbers together, because here is what should be sitting with you as you finish watching this. The U.S. Treasury's next quarterly refunding announcement is scheduled for the first week of May 2026. Watch the duration composition of what they announce. Watch whether they continue skewing short versus locking in long. Because if the short bill concentration increases again, if they double down on rolling rather than locking, that is the Treasury telling you, in the most official language possible, that they expect rates to come down significantly. And if rates are coming down while inflation stays elevated, you will know exactly what that means. The debt doesn't disappear. The dollars holding it do. Now watch what happens. This is not financial advice. Your money, your decisions.